to 9, called the Global Market Pulse. Have a good time every morning, pre-market. Try to cover quite a few things before the broad markets open in the United States. Please feel free to join us. And what we're going to do today, we're going to try to get two good relationships of mine on the phone with us as soon as we can. Hopefully have some video. Steve Benger hopefully will be joining us the first hour here. We're going to also talk to Steve Dahl the second hour. And one of the things I can see that some people are making comments about my Tom O'Brien tiger growl here, and I apologize for it being not exactly the same, but we're going to try to get through that. We're going to talk with Steve about some option plays, and you know, if you watch my show every morning, you know that we pretty much follow the rule of our profile derivatives, our market profile derivatives. And what we're going to do is talk to Steve about some S&P plays possibly, and some volatility plays around options based around some of those profiles. And one of the things that you know, he has really specialized in over time. He's been a member of a lot of different exchanges, the Life Exchange, the CME, quite a few different, and I've got a list of those exchanges here. They're pretty extensive. Eurex, CBOT, Matif, the Milan Stock Exchange. He's traded a lot of volatility products, worked with a lot of hedge funds. So hopefully we'll be able to get him on as soon as possible. To talk about some of the ways to possibly look at some of these markets and maybe hedge some bets or take advantage of some things that are going on that might not necessarily be directional. What we've got now in front of us, if you're looking at the screen, is we've got the S&Ps. We've got them on a long-term basis. 1975 has been a big number that we've been talking about for a while, that have been the upper targets when it comes to trading these S&Ps. And we've talked about buying support and buying breakouts really from the 1832 level. That was about 150 S&P points ago. And the reason we've been talking on that level is because we've used the internal breadth statistics that we look at, and that's an aggregation of our internals of the S&P 500, looking at profiles and getting a net positive negative number, and being able to look at the inflection points along the way on the S&Ps, mainly looking at the dailies to kind of regulate that weekly trade to the north side. Now, we've looked at these targets at 1975. We almost reached them last week. We backed off. We found support again at 1918, this midpoint of this current long-term profile. And as we approached it yesterday and today, we talked about, you know what, it's not time to really look at this as a let's reverse everything and go short opportunity. We've looked at it as we've reached our targets. We need to sit tight. We got a huge report tomorrow morning, and we have to kind of wait and see where we have a Friday's close. Now, if this thing completely comes unglued on the upside after that report, then what we want to do is kind of, you know, let things settle out. We always want to trade the reaction, not the action. It might be time to sit on your hands a little bit and just kind of, we've gone a long way pretty quickly. We've got a lot of the internals of the S&P 500, a lot of the ETF structures, all that, you know, that comprises the S&Ps. We've had a lot of those show signs of, you know, we all want to head north. But again, you know, we've gone a long way in a short amount of time, and we're going to try to decipher, you know, what might be the plays now that this is, you know, in front of us. And I think we have Steve on the phone now. Steve, are you with us?
Hey, John, how are you? I am here.
Man, it's good to hear your voice. How are you?
I'm good. It's a beautiful day, right?
Good. Yeah. Well, I to some degree introduced your background. I alluded to the fact that you've been a member of the Life, the Eurex, the CME, the CBT, the Matif, the Milan Stock Exchange. You've worked with hedge funds for years, and you know, the option arena is something you've focused primarily in, and I'd really like for the listeners, if you can, to kind of get a piece of your mind when it comes to, you know, what the volatility plays might be now, and possibly some direction on the indices themselves.
Sure. I mean, as you well know, John, everybody is always trying to find a better mousetrap to figure out where the market is going. And my particular mousetrap is basically trying to figure out where the market is going based up on volatility directions and the structure, the volatility structure of the market. And that's basically where I see my edge in a nutshell.
Okay. Um, what would like? Okay, so we've traveled a pretty good ways in a short amount of time here. When it comes, are you looking at, the volatility picking up? Are you looking at on the S&Ps? Do you think we might settle back here, or do you think we have, something in store farther? Creeping farther north on this thing, because I mean, we're trading above a long-term profile now, above 1975, and do you think the VIX is gonna, what are your feelings on the volatility index itself?
Well, I mean, in a nutshell, and just to provide some perspective for your listeners, the volatility curve serves as a spring. And when the volatility curve is compressed and it's kind of like inverted, I will talk about that in a moment, you have the potential for significant declines in the market.
Okay.
And that inversion in volatility basically means that the future volatility, as can be seen in the futures contracts, is trading at a discount to the current VIX index value. And that actually has been the case for pretty much, I want to say, 42, 45 days up until earlier this week. So earlier this week, the volatility structure actually reverted back into what's being called contango, whereby future volatility is once again trading at a premium over and above the current volatility number, and the VIX right now is at a 16.54.
Okay.
So for the market to go higher, we need a normalized environment, and that is what we basically have right now.
Steve, I hear the music. Can you stay on the line, and we'll come back after the break, and I'll probably have Andy Hecht on also.
Sure.
Okay, great.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit tfnn.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of tfnn.com. Futures and options trading involves risk and may not be appropriate for all investors. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. And Steve Benger is with us. We were trying to get into, to some degree, about some option plays here with him. Steve, are you still there?
Yeah, I'm here.
Yeah, and we're talking specifically about the volatility index. If you could continue a little bit, that would be awesome.
Yes. So what I was saying is for 42 days, we were in a situation where the volatility curve was inverted or in backwardation. And that actually normalized earlier this week. So because of the normalization, the way I look at it now is that the market should basically drift higher.
Right. So what we've done, I'm showing our daily I'm showing our daily profile chart here with the S&Ps. I was showing the weekly before, and we talked about that 1975 number. What's happened is when we started, we had a little bit of a divergence here with the S&Ps as they were going down. Then we were kind of starting to get inclined to start buying above that 1832 area, and we've used the daily profiles to really kind of regulate that trade up. And right now, like Steve was saying, the volatility index coupled with looking at the internals, and I'm looking at our breadth calculations, Steve. I'm showing we had this big crossover happen in the internals about the same time we started crossing the border of that 1832 area around February 19th that week. That passed there. And with what's going on, like with the report tomorrow morning, because this is kind of what everybody, I'm assuming, wants to know. If we have this big report coming out tomorrow morning, do you think the impact of that, like, do you think that could rattle the whole cage, and we could, all things considered with the volatility index and the breadth calculations, do you think we could, always we could have the downside risk, but what are your thoughts about how to play that?
Well, obviously S&P right now is basically at the top of its range, right? And if you look at possible retracement areas, we are now bumping up against the 61.8 Fibonacci retracement level, which comes in right around 2000, like 1999, when you look at the the November 2015 highs and versus the lows from earlier this year. So I think we are running a little bit of overhead resistance here, and the market is sitting at the top of the range. So I think, just gut feeling, going out on a limb, and I usually don't like to do that because people always call you out on afterwards, right?
Of course.
Yeah, but I think no matter what the number is tomorrow, the market is going to drift back a little bit here, but I believe that any type of weakness should be bought.
Yeah, I'm tending to agree with you there. We've kind of got a collection area, it seems, down, in a support fashion now, and these internals, Steve, I was looking at, I'm looking at our ETF profile grid right now on our long-term, intermediate, 4-hour, 1 hour. We've got one red cell out of, what is that, 4 times 4, 16 different cells. The utilities are showing, to some degree, negative breadth, just barely on our daily, and that's basically because the 10-year and the 30-year pulled back a little bit, and that dividend play on the utilities has just kind of evaporated a little bit, even though I still like the utilities. A lot of these internals, what I'm trying to say, Steve, are from a net profile, net positive breadth, negative breadth, are just screaming north. And that's, yeah.
If I may add to that, just because you touched on the utility, and as you know, John, I only started looking at your scanner recently. The fact that the utilities, which traditionally serve as a defensive play whenever the market heads south, are now trading at the bottom of your profile and signaling weakness, if anything, is actually a bullish indicator for the rest of the market.
Right, right. Yeah, I'm going to pull that up right now so we can see that just an ETF situation here. What you said is really important, and what we've been talking about all week is, the utilities have kind of, found some support again, but this is the overhanging concept here. We've got a new profile attempting to appear. That means a new supply area, if you will, above the market on the utilities, which, as you said, is, it's kind of interesting how these things have kind of slowed down a little bit. And that would be a new trading range at bare minimum that's going to be sitting there for the utilities. And it could, again, continue to move north. I'm really impressed, actually, how it hasn't pulled back more. And the 10-year, I'm looking at the 10-year too, Steve. Mm-hmm. I'm going to pull this up so you can see it. The June contract, we have busted down below our daily profiles, but, we've got a weekly, bottom of our profile here on the long term, which takes precedence over that. And then do you think, because talking about the utilities and how these things are interconnected, do you feel that, the treasuries might relax even farther here? Considering what you said about the S&Ps and that inverse relationship, what do you?
Well, I think generally speaking, no matter what, we're in an environment where we're going to see lower rates on a global level. I think that's true for Europe, that's true for Asia. So I think lower levels are here to stay, and the trend will continue. So there might be a short-term blip tomorrow when we have a really strong, or if we were to have a really strong unemployment number. Right. I think anything above 220, 230 would certainly do it. Right. But once again, I think that rates are gonna go lower, and that in turn should support utilities, because at least in theory, the dividend in the utilities is a little bit better supported. And that is certainly worth to consider then.
Right, and in turn, market seems to like lower rates. It's been a different scene, actually a good double-edged sword over the past 6 or 7 years. Market loves bonds and notes going up, so.
Yeah, if you really think about it, and I know I'm stating the obvious here, right? But the stock market, at the end of the day, is a supply and demand play. And right. I'm not necessarily talking about individual stocks. What I'm really talking about is a supply and demand play on money, the amount of liquid available assets which can be injected or have to be withdrawn out of the stock market. And the truth of the matter is, as long as rates stay low, it is an indication that there's excess money swapping around the system, which is the declared goal of the central bankers anyhow. Right. And as a continuation of that play, it really means that excess hot money, I like to call that hot money, which is swapping around the system, will find its way into the stock market.
That's something else to think about here. And, it's also kind of a safety play. You look around the globe, it seems like there's so much unrest or uneasiness or indecisiveness, I guess. This may just continue to be the U.S. stock market, and the notes and the bonds just continue to be the place to park money, period, which would again put a bid in the marketplace. Yeah.
So let me ask you a question here, then, John, because you're always the one asking me questions. Okay. What do you think of gold? Because that's the one thing I can't figure out for the life of it right now.
You know what? That's the scary thing. We talked about that this morning. I'm finally becoming really bullish on this thing. Not hopefully not picking the high print, but we're actually now are this minute in eclipsing the top of our profile on our long-term weekly, which is really weird that all this is going on with gold at the same time the market's going up. Steve, thanks for coming on. I know you got to catch a flight somewhere.
All right.
Thanks again, man. Okay, we'll be back.